Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. It is Wednesday, July 24th, Elizabeth. We are live on air.
We're right
1 p.m. on the East Coast. Dan, Nathan,
That's me.
Elizabeth, myself. They're in white. Sorry, not sorry, because when you wear white on TV, you get washed out.
Yeah,
There's no R in
back.
washed.
You're not supposed to wear white, black, or red, and I wear all.
And
of
you
the
wear
three.
all three of those things. It's great to have you back, by the way.
Thank you. It's
No,
good to
can
be
I
here.
tell you something? Not only do Dan and I miss you, but actually, more importantly, the audience misses you.
Yeah.
They reach out
Oh,
and they say, "Where is she?" I'm
Yeah.
like, "Well, now she
You
was in
can't
another
dox
way."
her. You can't dox her.
Huh? I can't what?
I don't know. what
Dox
that
her.
means either.
By the way,
you're back, and there's just tons of news.
Yeah.
The markets are finally moving again. You know, Guy, we were like
the markets have been moving.
yeah, but just up.
Yes.
Yeah. So the last couple of days, the last week or so, they've been generally moving down.
That's more exciting.
But you missed this rotation in your most favorite group. The Russell 2000 went up in a straight line.
14.
I didn't miss it. I
10
wrote about it
14.
last time I was here. Yeah.
No, you and I had the conversation.
Oh wait, I wasn't here. You're right. I wrote about it last week.
All right.
and
By
I
the way,
wasn't here.
we have Butters today.
Okay.
Typically, it's a Thursday thing, but we've decided that Butters works on Wednesday.
Well, Liz is here on Wednesday, and you always have some great things to add to Butter's work as a strategist that you are, right?
Thank
So that's
you.
why we just started
Strat.
doing it on what? Yeah.
So it used to be Liz Young Strat.
Yeah.
It's probably Liz Young Thomas Strat
It's a
now.
little
It's just Liz
It's-
Thomas.
it's a-
Strat.
Oh, just Liz
It's a
Thomas
mouthful,
Strat.
guy.
Do people have to refollow you, or is it just sort
no,
of grandfather
you can do it.
in?
You can change it on your own.
No kidding.
Yeah.
I like my handle.
Twitter has to approve it.
You're Guy Adami.
That's just, who else would I be? Put up the rundown, please. Big cap tech wreck. That is, in fact, true.
Yeah.
As you mentioned, small cap gains continue. We'll see how long that lasts. Butters.
Just
See,
Butters.
no. They have an exclamation point.
Yeah.
And when you see something like that, that's how you're supposed to read
That's
it.
Jacob's fine work. Jacob is manning the helm today of market.
Amanda's getting like a root canal.
Yeah, she's
Typically, watching us is akin to a
Yes.
root
Yeah,
canal.
so she's
but
ready.
she's
for it.
actually getting a root
Yeah,
canal
yeah.
today. And if we have time, which we should, a little audience Q&A. So let's get right into it. Let's look at the S&P 500 because that's our want to do. And let's throw up the chart. This is our channel. It's a worth charting channel, which is not easy to say.
Mhm.
Seemingly, we have breached the lower end of that channel. We'll see how long it lasts. But I do think this is important. Elizabeth, I know you look at charts from time to time.
Mhm.
You and I actually rode up in the elevator together,
Mhm.
and we said something akin to risk does happen fast. And you're starting to see it around the edges today.
Yeah, I mean, I'm no technician, but looking at this chart, I don't think that's how it's supposed to look if we were in a sturdy upward
Mhm.
trend. So there are some questionable things going on in the market right now. There's also a lot of commentary happening on the macro front. There was a paper, I believe, by Bill Dudley that
Mhm.
came out today talking about the Fed needs to cut rates now. So now we've got all this speculation about maybe we'll get one in July. I don't think we will. Maybe we get 50 in September. And it's just the anxiety is rising. And after a market having rallied so much as it did, we're now seeing, which is something that I've talked about, I'm sure you guys have talked about too, when selling pressure comes in, people sell the easiest stuff first.
Mhm.
And sometimes they might have a reason to if there's a fundamental weakness going on. But the easiest stuff to sell first is a lot of that large cap space and everything that has gained so much, because you look at your portfolio and you say, where can I trim? I trim where I have gains. And that's those names. So that's part of what's dragging some of this down. And, small caps haven't seen too much of that pain, but they may as time goes on.
Well, they've just seen massive underperformance
They've seen for a long time.
years. Yeah.
Yes. But they had this huge run up. And now I think what's keeping them elevated is that yields continue to come down.
Yeah, no doubt. I mean, listen, those charts, by the way, so the S&P 500, let's throw up the NASDAQ, the NDX, the NASDAQ 100. Carter was with us yesterday. He went through these charts. We talked about the relative underperformance
Mhm.
from the highs of the NDX, and that just speaks to the rotation we've seen into the Russell 2000. And so, guys, this is interesting to me because, again, this didn't even make an attempt at that former uptrend, right? And you ask Carter the question, right? And, Carter, made this point, and I'm really glad that he did. If we want to toggle back to the SPX chart, is like, listen, these trends, they're not, they don't always have to be perfect. And if you look at that, that is to the penny. But let's just say, for instance, we had this bad break. And if we don't close on the lows, let's say we make up some of the losses towards the end of the day, and let's say it closed near the high of the day, and then it follows through to tomorrow. So that's how you can get faked out a little bit by just looking at the charts, which I'm glad you brought the point up about rate cuts, because obviously this is a bit of a macro thing on top of the earnings that we've seen over the last week.
Well, the chorus now for rate, especially now if the market were to do something. Now, today's obviously one day, although the last couple weeks has been a little dicey, if I may use that word. But when you see a market move like that, the chorus of people calling for rate cuts is just going to get louder. And as Elizabeth has said before, and I have mentioned, and I think some other people now on Twitter saying, be really careful what you wish for in terms of these rate cuts, because if they come in the fashion that they may, for the reasons that they may, it's because something is happening. And, real quick, you talked about macro. We might as well talk about it now. I was going to tee you up, but as you and I rode up together in the elevator, we had a conversation about the unemployment rate. And I said, at a certain point, Elizabeth, when does that kick in, that rule that you invoke all the time?
First of all, isn't this what you guys talk about in elevators? You talk about the unemployment rate.
Well, what do you want it to? Well, okay, so stop for a second. People typically get people can be talking outside the elevator in the foyer of, let's say, a building, and they're having a lovely conversation. And everybody knows this. For some reason, when you enter the elevator, those conversations stop. I don't know what it is. I, by the way, am not one of those people, as Dan has seen many times. Like, I'm a chatterbox in the elevator, and it makes people very friggin' uncomfortable.
You chat up strangers in the elevator, not just the person that you're
with.
Well,
what is a stranger, really?
You look
Aren't we all strangers?
You look at some guy, and he goes, hey, Junior, and he just starts talking to him. Or there's some woman in there, he goes, hey, chick. Like, it's kind of awkward.
It's not awkward. You know what? When you say the word awkward,
makes you feel
that's
awkward.
When things get awkward.
I think it's because it's a confined space.
Oh, so
there's no privacy. So you can't have a private conversation. So if you have a conversation in such close quarters with other people, they have no choice but to hear everything you're saying.
True.
And then you feel very exposed. I think that's why most people feel
You think
awkward.
so? So once you're in the box, like, people just get freaked out.
Yeah, I don't know.
And
so back to the careful what you wish for, because I actually
and go, because I want to hear about the unemployment thing. But please.
But really quickly. So Jacob this was a tweet, guy. You just said it. It's Peter Berezin, Berezin, and we'll put it in the show notes. I saw it on Twitter this morning. Really, a reality alert. In the past, the first Fed rate cut was a reliable sign that a recession was about to start. Will this time be different? Liz, you made that case on many occasions. Okay, I'm going to give it to you in 1 second. But pull up this. This is just showing when the rate cut cycles happen. You can see in the gray columns, that's when the recessions happen. All right, talk to us.
Yep. So the market typically bottoms after the first cut. We don't usually see a bottom before the cut. So everybody that thought the bottom was in November of 2021, that wouldn't line up with history. Now, of course, things that have never happened before happen all the time. So could it be something that is new for everything? Sure. I still don't think that that's going to be the case. I think a lot of these indicators have been very classic late cycle behavior. We got here because of an imbalance between supply and demand. I mean, a lot of this stuff really is textbook, aside from the fact that it all began with COVID. That was not textbook. But everything that happened afterwards, supply shortages, demand overage, that we had this huge inflation surge, the Fed hiking rates so quickly, and now what's happening in the market where we've had large cap dominance for such a long time and small caps failing to take over, that is all very late cycle behavior. Unemployment rate turning up, hiring market getting back in balance, but teetering on the edge of being imbalanced to the other side. So yes, after the first cut is usually when a recession starts. Here's the weird part about recessions, though. Those gray bars are declared by an organization, the NBER. They don't declare recession until about 6 months after it's already begun. So we're not going to find out in real time that we're in a recession. We're going to have to look at the indicators and conclude it on our own. But typically rate cuts are not a good indicator for the economy.
The other thing is you were talking about the 0.1% higher in the unemployment rate. So a 4.2 off a 3.4 low knocks in or kicks in something called the
SAM rule. That's
Please.
SAHM. Now, no indicator is perfect, but the way that it works is if the 3-month moving average of the unemployment rate is 50 basis points above the previous 12-month average, that triggers what's called the SAM rule, and it has been an indicator of recession in the past. If the unemployment rate goes to 4.2% next month, it will trigger.
And I believe, and as you know, I believe, again, I thought it would happen a lot sooner. You mentioned late cycle. I think, and I can only speak for myself, but you would probably agree. I think what I got wrong was the amount of sort of liquidity floating around that sort of elongated this entire thing and allowed the market to do what it's doing. But it doesn't change the fundamental thesis that we've been in late cycle for quite some time. So for anybody out there that you hear early cycle, mid cycle, it's just not factually accurate. The fact that, again, we've been here for as long as we have is an anomaly, but it doesn't necessarily change what I think we're on the precipice of.
Right. Just because it's lasted longer doesn't mean it's not going to happen.
Correct.
And that's constantly the pushback that I get. Well, then where is it? Where's the recession? Just because it's not here doesn't mean it's not happening. Or just because late cycle has been elongated doesn't mean that we were in mid cycle in the beginning of the late cycle phase. It's been late cycle, unemployment rising, inflation coming down, now growth slowing, and even the market behavior, inverted yield curve, is all very late cycle behavior. The argument has been that AI is what changed that, and that the productivity gains that we could get from AI changed the game, and that we could actually move back to mid-cycle if that picks up.
Right. And, listen, this is something that Guy and I have been talking about. I feel like for a year since, it's kind of we're 18 months away from when ChatGPT was introduced. I think that was late 2022. And that really did give, I think the markets, not exactly the economy, but the markets a reason to believe, right? And so we've had this massive run. Obviously, we had that period in March of April of last year when we saw some regional banks go under, but it's the promise of what you just talked about, the promise of productivity gains, the promise of better processes, working their way across, all different industries. And, but to me and Guy, I mean, this is like, we've seen this before. You know what I mean? Like the analogs to the late 90s into the early 2000s, people will say it's different this time. It's very similar. The sentiment's very similar. The mania around technology is going to be similar. And it's not going to be the last time this sort of happens, which is why, you talk about liquidity, you talk about leadership, you talk about people selling the things that have had big gains, and liquidity is really interesting. So let's throw this slide up of the Mag 7. Our main man, Jacob, who's manning the helm today, he's calling it the Drag 7. I love that. Yeah, that's pretty good.
Tremendous.
But one of the things I think is really interesting, we're looking at the losses on the day by all of them, which are fairly large. Okay. And then the year to date. I just want to focus on the year to date for a second. So if we're calling these the Magnificent Seven, look at the fact that basically Apple, Microsoft, and then Tesla have massively underperformed, the NASDAQ or the S&P now over the course of this year relative to what you would expect them to do relative to some of those other names. So I think some of the leadership is starting to wane. And when you think about a day like today and the earnings that we got last night, Tesla rallied 85% from its April lows. Now it's come in pretty hard, Guy, and I'll let you speak about that. But Google, did you expect when you were looking at that report and the guide that they gave and the commentary that the stock was going to be down 5% today?
And I said, what I said last night, what I said in the earnings was the setup wasn't particularly good. We've seen the stock run and then have pullbacks. I thought when I saw the quarter was fine. I think the capex spend from 12.17 billion to 13 point whatever 15, I think scared some people. Obviously the tape is not helping, but what I've said for a while is, Google's one at least you can make a compelling case in terms of valuation around, and that's held up to a certain extent. The one that continues to stick out to me, and I'm not a hater, I don't really care. I've never met the man. I'm sure he's lovely, but pull an NVIDIA chart up and we're going to look at it again for the 100th time. And I'm sure a lot of you are bored, but look at March 8th. Look at that again, that engulfing pattern that we had. Look at the sideways action that we had for a couple weeks, and look at the 24% move lower by the middle of April. Then obviously we had the huge run up. And on June 20th, we had the same engulfing pattern. We've had the same sideways action, and the same type of thing is setting up. So what I pointed out in March and what I'll point out again is the fact that the broader market did catch up at a certain point, and we're starting to see that. NVIDIA, you can't underestimate or you can't understate how important it is, I think, to market sentiment.
Yeah,
Dan.
two things I think are really interesting. So, Guy, you just mentioned the guide a little bit higher for Google in CapEx. This is something we were talking about. It was going to be a good read through to NVIDIA, and the fact that they just guided up a little bit. We used that example with Meta last quarter where they guided up CapEx a couple percent. Obviously, that was great for NVIDIA. They're buying tens of billions of dollars of these H100s, and they'll buy the Blackwell, the B100s, whatever the hell you want to call them. But here's the thing. I mean, so that small guide higher in CapEx is causing this sort of decline. I don't think that's exactly the case, but I think the main point here is that the acceleration in CapEx is starting to decelerate as we've seen over, and that could lead into some of the things that we've just been talking about. If you can't show us how these investments are basically being monetized, then sooner or later, you're going to have to slow those investments, right, Liz? So talk to us a little bit about that, and how does that feed into your view on this late cycle economic environment?
Well, it started last quarter. As I talked about it then, it started to become a zero-sum game. You talk about investing more in AI, and stocks started to get punished for that because investors now want a reason why you're spending that much. You have to justify the spending. And this is interesting. A top news story on a data provider that I use. Stocks hit as traders want signs AI is paying off. And then the first sentence is, stocks tumbled after a disappointing start of the mega cap earnings season, fueled speculation. The artificial intelligence frenzy that has powered the bull market still needs to pay off. What does that mean? It means, where's the profit going to come from? All this spending is happening. Where's the profit coming from? When is it going to expand margins? What are all the use cases?
Right.
And I'm not fighting against the fact that it will eventually pay off.
Eventually.
But not in the next 12 months. And stocks trade on forward 12-month earnings. So it's probably not going to come to fruition by the end of this year. And investors are starting to get discerning on, yes, please go invest in that, but still show me where I'm going to get my price.
It was the same thing as the build up into the metaverse in 2021. I mean, like, let's be clear. And some of the same players were involved in that. And Guy, you know, we often play the heel on the desk on Fast Money. Like if we have
heel, like the
bad
heel,
guy.
bad guy.
Yeah. I mean, part of it is like, if there's a universal bullish view on something, we'll try to take the other side a little bit, because intellectually, I think that's pretty useful if you're watching a show like that or whatever. And there was one day we were talking about, there was a couple really bullish folks on NVIDIA, and it might have been right around the period where you had that run up, but you had this reversal in June 20th. And, you know, they were talking about, well, the return is going to come. And I looked at them and I was like, it's not going to come for quarters and possibly years when you think about it, right? So the investment they're making right now might be the best investment they can make if they're thinking long-term about how this technology is going to transform the business. But I just remember I got a lot of hate that day, Guy.
Which is because it ended in a Y that day. I mean, that's just typically what happens. But Sequoia Capital had a note out talking about, was Elizabeth was just saying, Goldman Sachs did, Roger McNamee, all within the course of 3 or 4 day period a couple weeks ago, pointing out this. And I think more and more people are going to start to come to the realization. And I've said this 100 times. I know the spend is there. There's no question. But at a certain point, you have to you have to prove the case as to what the spend is for. And there's a return on investment. And by the way, I'll just throw this out there. If you're watching the NFL, the National Football League, to see the cheerleaders, you're a freaking loser.
Who's doing that?
So wait, hold on a second.
Oh, that's not it.
If you're watching the network to see the cheerleaders for the stock,
oh, I see where you're going.
it's the same thing.
Yeah, they take out their pom-poms.
Don't you know? There are a lot of pom-pom people out there, and I get it, but you also need voices every once in a while that can at least attempt to punch a hole in some of these theses.
Well, it's important as an investor, and I say this to myself often, always seek out evidence to the contrary.
Yes.
Right? Whatever you believe, find the evidence that says the opposite thing. And I do try to find it. But then when I make my lists most time, I've got a lot more bullets in my own
Well,
column.
then you have to take a view, right? Like, so like, you know, that's been my view forever. I learned that 25 years ago when I started the business. But the guy I worked for is like, if you're going to make a bullish case on something, I want to know how it can go pear-shaped.
Right.
You know what I mean? All right, let's rip through some of these drag 7 stocks today. We don't have to go in depth with Tesla. We talked about it last
night. Put it
night.
up real quick.
Yeah. I mean, here's the 200-day moving average. Guy, we didn't need to draw any lines. It probably goes back towards 200. I know that's something that you had been saying, I think, for a couple of weeks. If you think about it, it's going to retrace probably half that move since it took off of that base. totally makes sense. 200 days should probably be some support. But guy, based on what you heard from the company, I listened to the conference call, man, this story, he's trying to divert it as far away from EVs, that would be electric vehicles, and saying, don't look here, but look over here at all this whiz-bang sort of stuff.
Taxi. I mean, that's
Dojo, supercomputers, it's humanoid robots.
And Gene Munster was on. You have Gene on OK Computer often. He's brilliant in what he does. And he says, he understands that this is not the quarter to necessarily be looking out towards that, but he believes that's still sort of the bulk. If it comes down to what you think Tesla is, right? I mean, if you're just looking at through the lens of an auto company, I mean, those margins were disappointing. And as I pointed out last night, it continues to be a margin story. And when you back out, so EV credits last quarter were 12%. This quarter were 20%, I think, of profits, I think of net profits. When you back that out, margins go down to 14.6%, I think, which are trough margins for them. And we haven't seen. So
you better hope they're trough.
Well, no. I should tell you the wrong story.
Yeah.
They're at their lows. I'm not. Maybe they're not trough. It could get worse
from
from
like
there.
25%.
Which, by the way, yes, and they told us, I think, 2 falls ago that, hey, guess what? Our margins are to decrease. That's when margins were mid-20s, but we're not going to get down to legacy auto levels. Well, guess what? Not only have they gotten down to those, they've gotten through those on the downside. So that case is out the window. So I think you're hanging your hat on this robo-taxi thing, which a lot of people feel is trillions of dollars addressable. I have no idea. In terms of technicals, though, I mean, throw up a longer-term chart. We have seen this movie before. This was a stock that basically went from $108 to $300 and then gave almost the entire move back. And now we've gone from 138, I think, to the current levels, and now we're starting to give it back. So we have seen huge bounces in this stock in the midst of a 3.5-year down cycle, Dan.
Yeah. So, Liz, this is a great example. You don't have to opine on the stock individually, but like this was kind of a bubble stock here. People don't care about valuation. They care about the long-term opportunities of one of the best salesmen that has ever lived on this planet, right? And so when you think about that, you think about the positive sentiment. There's other names that are less exciting, you know what I mean, that are basically benefiting from a multiple perspective or a multiple expansion during the session. So I wonder, do you worry about the concentration of these names? And it wouldn't take much to get these things, most of them down, let's say 20% from here, which to me, you can rotate all you want into the Russell 2000. It's basically the market cap is smaller than Microsoft or Apple or something like that. So what holds the market up if there is the sort of sell-off that we had from July of last year to October? Is there anything that can step in there? And
if a sell-off hits the mega caps like it did last year, I don't think that there's much. I mean, everything else in the market would have to come off the mat. And wasn't Nvidia down? I mean, during that cute little sell-off that we had earlier this year
in April,
it was a 5% correction in the S&P 500, and Nvidia was down 22%. But that just goes to show what some of these names can do. And it goes back to the earlier point that your biggest gainers are usually the first ones out the door. So the risk in concentration is not only if people get nervous and they want liquidity, those are the ones that are most affected, but also just the ETF holdings.
Why are they selling banks? So pull up JP Morgan for a second, because this has become a very, very crowded. Talk about that guy, because again, most of the banks are trading at 52 or multi-year, and JP Morgan's situation, all-time highs. Like that seems to be a very crowded trade too.
Well, I think part of it is a perceived flight to quality, number one. This yield curve steepening, I think, is number two. I mean, the fact that you have these cries, as Elizabeth mentioned earlier, for not only maybe a 25-point rate cut, but maybe a 50 basis point rate cut. So I think that is the perception is that's supportive of banks, which I understand. But I think the market is missing the bigger picture, which is the underlying weakness that is sort of driving this entire train. And throw Bank of America up because, and listen, I've never met Brian Moynihan. I'm sure he's lovely. I find him to be sort of the Roger Goodell of the banking industry, a guy that gets paid a lot of money that really, if you met him in person, is not impressive at all. And that's Roger, because I've met actually Roger Goodell. I'm like, holy shit. Anyhow, they just reported earnings. Book value in this stock was, I think, $33.65. You see where it's trading. In my opinion, just looking it through the lens, Bank of America should not be trading at a premium to book value. This is one that at a certain point is going to find its way back down. So they have a lot of headwinds without question. And I'm not picking on Bank of America, but since you brought up banks, I thought I'd throw it.
All right,
out
let me just do one thing really quickly here, Liz.
Please.
So if you're looking at JP Morgan, which is trading very near, let's pull that back up for a second, very near an all-time high. Okay, just came off a little bit. So I have 210.5. It's up, a little bit here today, like pennies or whatever. If I look out to September expiration, okay, the 210 put, again, stocks trading at 210.40. The 210 put can be bought for $5.25. So you want to figure out on a percentage basis what that is, people? It's about
4.5.
No, about 2.5%. I mean, think about that. 525 on 210. Okay, it's about 2.5%. Think about that to the downside.
You're right. Actually,
I know I am.
20
So
now.
think about that.
It.
So your break even is basically down at 205. So if you're long this stock and you for the next 2 months or so, that could be protection, or you could make a directional. But I mean, think how can it be that cheap, guy?
It's also a vol play too.
I know, but your head immediately went to it's got to be 5%.
Yeah,
you know what I mean.
Yeah, and that's where and it's not.
Well, vol is just cheap. That's the point.
That's the point. Yeah. And I think it's part of this is a vol. It's a directional play. It's a vol play, and it's a way. It's when people. It's a complacency play. No, I like what you did there. I mean, we're doing this shit on the fly. I'm not supposed to curse apparently, but Amanda's not
Liz,
here.
What do you got for us on the banks?
Let's look at, if we can, throw up a chart of the 2s10 spread.
Yes.
For me.
Yes.
And I love that this is happening on a day where Guy is sitting next to me. We've got a 2s10 spread at a high in a long time. It's been a while. So since January of this year, we've got a spread of about 15.7.
Where did we get down to? About 14
in January. The high then was, I think, 15.
Okay, but
15.8.
She was saying something about the steepening. Was that what she was saying?
Yeah.
Well, no, it's here we are.
Yeah.
And it did get down to something higher back in October 2023. That day, intraday, 11 basis points. But we haven't seen 15 basis points in a long time. Okay, the 2-year has come from 5% at the end of April down to 4.40. So that's a drop of 60 basis points. The 10-year is down 50 basis points from around that time. And then we talk about the banks. I think what's happening right now in the market is it's not something that happens in a straight line, right? The initial phase is that, oh my gosh, this has to be good for the banks, right? NIM increases, net interest margin increases. And yes, that is true. And they're going to benefit in the near term because the idea is if we don't go into a recession, they can make more money on lending and they don't have to spend as much on deposits. Totally get that. It's simple math. But it does depend on the idea that we don't go into a recession because banks are a cyclical sector that if things start to turn down, like we talked about in the elevator by ourselves, somebody was listening.
No, there were a couple cats in there.
There were other people listening. They didn't join in, but it happens quickly. So, and who knows if it happens or not. I think what's happening right now in trading is that people are assuming it's not going to happen. And that's okay. I did talk about this a few weeks ago where initially I think financials benefit from a yield curve steepening. It's a bull steepening where the 2-year comes down faster than the 10, but they both come down, which is what's been happening since the end of April. Banks benefit initially, which is what's going on. Real estate benefits initially. But then if there comes a turning point where the economy tips over, all bets are off on that regard.
Hey, Guy, really quickly, because we were talking about Visa last night on Fast Money when it came up. Pull up letter V up here. This is really interesting. You had some.
By the way,
comments.
Who started talking about this?
You did. You
back
did.
in like
but
the
really
spring.
Interesting because to me,
bitches,
isn't this a little bit? And this is going to be a good segue, Liz, to some of the work that you had in your note. But Guy, talk to us about this because there's no way to look. Maybe there's some competitive stuff, but there's a duopoly. I know
it's got nothing to do with competition.
Talk
I mean, think about when the stock and I know for a fact this is something we've pointed out, and I think 2.5 weeks, maybe 2 weeks or so ago, I saw for the first time in a very long time an analyst downgrade both Visa and MasterCard, which seemingly came out of nowhere. But again, these stocks have been vastly underperforming since making their all-time highs in March. I think this is Visa, MasterCard's going to look very similar. So there's no reason to put that up as well. What it speaks to me is the market is sniffing out transaction volumes declining because all this is all they are transaction plays. Decline in transaction volume suggests a slowing consumer, which suggests a slowing economy. So if you're not paying attention to Visa and MasterCard, I'm not saying you have to trade them, but you have to pay attention to what's going on. You're doing it wrong, in my opinion.
Well, the Citi CFO, and we highlighted this. So after they reported earnings, Liz, he was talking about how they're seeing some of the retail partners, some of the transaction volume slow a little bit, and then also from some of the consumers. So again, like this might be really early and what might be a weakening economy. You know, just remember a couple months ago, we saw, you know, inflation come down and we saw, you know, job gains just fine and everything like that. So you guys point, I mean, is something going to fall off a cliff this summer? I don't think so. You know what I mean? But it's a slow weakening of some of the economic conditions that were a great backdrop for risk assets like the stock market and housing.
Which a weakening is welcome to take care of inflation
that's what the Fed
once and
wanted
for
to
all.
do.
So and that's the evidence to the contrary that I have to seek out, that this is exactly what the Fed said needed to happen in order to completely take care of inflation. So maybe it's all going according to plan, but we don't know how it ends yet. So my note this week was a little bit of a preview because we've got GDP coming this Thursday. We're going to get Q2 GDP numbers for the US, expected to be 2% flat, which is fine. Nothing to be impressed with, but fine. If trend is 1.8%, technically still above trend. But what we did was we took a look at, if you break GDP down into what's called private domestic demand. So that's basically just the consumer component and then a business component. What it does is it strips out inventories, it strips out trade, and it strips out the government. So this is the spendy and sensitive stuff in the economy. Okay. So if we look at private domestic demand, just look at what is going to happen Q2, Q3, and Q4 of this year. Nothing terribly ominous, but certainly a slowing. And private domestic demand is what's been holding growth numbers up. So we're going to lose that little tailwind and the steam comes out a little bit. Growth for the third quarter and the fourth quarter overall is expected to be 1.5% in both quarters, which would be below trend. Again, perhaps all going according to plan, but definitely something to watch. So then dig deeper. Talk about retail sales, talk about some of the bellwether companies. There are different ways to gauge the consumer. If we go to the next chart of retail sales, here's what's been happening in retail. Now, this is admittedly a bumpy data set, unpredictable. Sometimes it gives you false signals. We see a couple of those on this chart, but you can see that there's been a weakening. We have a line there. That's the 3-month moving average of retail sales. So there's been a weakening. And then I even mentioned in my note, which you haven't even seen yet. So it was a great tee up that Visa missed on revenue and UPS missed estimates. Those are two big bellwether companies. And then if you look overseas, LVMH missed. So you've got a Chinese consumer. If we go to the next chart, Chinese consumer that's weakening, China disappointing on growth, those companies that are dependent on a Chinese consumer for spending, and luxury brands just in general, not even just because of China, are suffering. So there is something to be said for this. Again, nothing yet that's conclusively a terrible signal, but at the very least, there's rumblings of a slowdown, and it's something that can happen quickly because, as we know, consumers are sensitive. They're sensitive to sentiment. They hit the pause button quickly. If people get scared about the labor market, that's what does it. I've been saying for a long time, the consumer will keep spending as long as they have jobs and as long as they feel like they can get a new job if they don't have that job. And I think we're hitting a point where they don't feel quite as confident anymore.
And you throw on top of everything that's obviously going on politically, and then you have, as they like to call, what do I call it, Dan? A what? Witch's brew. By the way, how can we find it for those that have just woken up from a 20-year slumber? How can we find your SoFi? There it is.
There it is. SoFi.com/on-the-money.
I know.
Look,
there's an investment strategy section there.
Yeah.
If you actually go to the website and just click on resources, there's an investment strategy section. So that's a little shortcut. But you can always find it on my socials as well. I will provide you with the link.
By the way, whoever's playing this tic-tac, they suck at tic-tac-toe.
Yeah. Well, somebody won already. Time.
No, you know what? It looks like somebody won already. But what I'm seeing, I guess that top right is in fact filled in. It's sort of a bit of a, I don't know, it's an optical illusion. But whoever's playing round balls, you suck. Okay. Maybe we should change that graphic.
That's right. Well,
it's not Mario.
No, it's the logo.
No, Mario's fantastic.
All right, really quickly here. Well, not really quickly. Let's do it.
Well, by the way, it's that time.
Yeah.
And let's just get this out because I was actually going to email him. Is it MARY-O or is it MAREO?
What?
So is it Mario or
Mario?
The way you pronounce
it.
But how is it?
But it's the A that changes, not the E.
What is so? What do you say?
Mario.
Mario.
And he will tell you it's Mario.
Okay.
The pronunciation is Mario.
I call him Mario. Anyway,
I'm gonna nail this. Okay?
Please.
So if it's Wednesday, not only do we have Liz Young Thomas on the show from SoFi, but we also get a preview of John Butter's earnings insight analysis that comes out every Friday. Look, that's where you can find it. You can get it in your inbox, insight.factset.com/subscribe. But we get a preview it on Wednesdays. We love John's work, and we especially love John's work when it's earnings season, because he's kind of tracking some data that we think is really important. You focus a lot on the micro when it's earnings season, but it's really important to think of things broader. So let's look at his report for this week. The blended net profit margin for the S&P 500 for Q2 2024, that's this quarter that they're reporting, is 12.2%. This marks just the second time the net profit margin has exceeded 12% since Q2 2022. Looking ahead, analysts expect net profit margins for Q3 and Q4 to improve to 12.4% and 12.5%. Guy,
stop right there.
Adami. Yeah.
That's so you could say it's funny, right? It all depends on the way you look at the world. I think the optimist will say this is fantastic. Profit margins are increasing and they will continue to increase, which, okay, I get that argument. Somebody like me looks at it and says, given the last 30 minutes of all the stuff we talked about, I'm hard pressed to understand how this might not be a peak in profit margins for the foreseeable future. So I look at this and say, to that movie with the great Jack Nicholson and Diane Keaton, I believe, is this, Dan, as good as it gets? That's how I look at it.
Yeah.
You want to split the tie here, or you want to sort of?
Well, okay. So what I just talked about, growth slowing, private domestic demand slowing, it's math. Okay. How do profit margins get made? Either revenue goes up and costs stay the same, or revenue stays the same and costs come down. One of the two has to happen, right? Or revenue can go up and costs can come down. If growth is slowing, if consumption is slowing, that means that revenue is probably going to slow for most companies that depend on spending. I don't know any companies that don't depend on some sort of spending. So if all of that is slowing, that means revenue growth is probably under pressure. So the only way that they're going to grow profit margins broadly is to cut costs.
Stop. And how do companies typically cut costs in a meaningful way?
Well, they try to do everything else first,
right?
Which we'll hear about. We've heard some of that already. Discretionary spending comes down, right? Maybe some plants get closed, whatever. They try to do everything else. And then when they run out of ideas and they need to cut costs quickly, they lay people off.
That's exactly right.
That's
exactly right.
I might, and you're going to get mad at me for this. If we have time, maybe even during the Q&A, there's a tweet that I put up today about warn notices. If we can pull that up, Jacob, I'll give you a little while. Basically, a warn notice is companies are required by law to 60 days in advance give employees a warning about major closures or major layoffs that are coming. The warn notices have risen. If you overlay it with, there it is. Perfect. Thank you. So warn notices are the blue line, and you've got a change in employment. You see that it's about to cross. Warn notices have gone up and employment coming down. Look at what's happened other times that those lines have crossed. It happens fast.
But we don't rehearse this. I want you to know, and I'm speaking to you right now. You and I, we don't rehearse, right?
No.
But sometimes I'm sort of in your head. And other times
it's scary.
It is a little.
All right, we both move on because there's another butter slide here. I think.
Oh, sorry, John. John.
So one of the things that I would just mention is, like, if you're talking about the potential for peak margins, right, and you're talking for the potential of, let's say, job cuts at some point in the future, you want to really focus on specific sectors, right? And so when we think about the sectors, you have it right up here. The 6 sectors are reporting a year-over-year increase in net profit margins, led by financials, communication services, and technology. So communication services and technology, it's basically the Mag 7, right? And so these names have actually been a huge participant in the earnings growth and the expected earnings growth going forward, the revenue growth and the margin growth. So again, if you were going to start to see a moderation in capex and sales and all that sort of stuff, that's how you get to peak margins, in my opinion. And the 5 sectors are reporting a year-over-year decrease in net profit margins, led by real estate and materials. So, Guy, when you think about that, like, if real estate and materials are not going to improve too much, and we start to see communication services and technology take a dip here, that's how you get your.
What happens again if there were to be a significant rise in the unemployment? What I have said for a while, the existential risk to the housing real estate trade is the unemployment rate going, because that is going to force the hands of people whose hands have not been forced yet. And what happens when there's more supply in the market? By definition, almost, you're going to see a decrease in prices, right? What does a decrease in prices mean necessarily to profit margins for real estate? it's going to start to decrease. Materials is a little bit of a different animal, but it falls in the same sort of subsector. So it all sort of makes sense to me. Like all this narrative, this mosaic, this whatever you want to call it, is starting to take shape, Elizabeth.
Yeah, it absolutely is. And this it's just another display of concentration in the market. So broadly it looks like everything is getting better, but really it's only getting better for a handful of companies. And that's definitely something to pay attention to. Look, I don't think it's going to suddenly change this quarter. We're hearing some commentary about things slowing down this quarter from CEOs, and I think that will continue. We also haven't gotten, what are we, only 25, 30% through earnings season. So a lot of those big retail companies we haven't heard from yet. Another big bellwether would be something like Home Depot, right? That's what you want to listen to. So we're still going to get a lot of commentary. I would expect that commentary continues to soften from CEOs and CFOs, especially in the retail sector and in the consumer focused sectors. But I don't think anything terrible is going to come out this quarter. I think it's either later in the year or into 2025 when reality strikes that people have really pulled back on their spending.
Yeah, I'll just say this, you just mentioned one of those high-end retailers. Which one? That
LVMH.
All right, LVMH was yesterday.
Louis Vuitton.
Gucci was today.
Mm.
Burberry was last week. They're all blaming China. Again, we don't talk about China a whole heck of a lot. It has not been an engine for growth really since COVID for all intents and purposes. I know people were really excited about the potential in 2022. And when you think about that, it never materialized. And we ended up having a bear market because I think there were a lot of expectations that China was going to save the day. I think they just reported a GDP print, which was lowest in a year, but it's far lower than trend over the last 10 years. So again, I don't really know what comes to save us, especially if over the last year, it was excitement around generative AI, which I think we all covered is not about there. Okay, well, you guys know where to find John Butter's work. It's the Earnings Insight blog. You can have it to your inbox on Friday morning. Okay, there it is.
By the way, and we're going to do Q&A now, but look at how poorly the dollar stores have traded, specifically Dollar Gen and Dollar Tree, for quite a long period of time. Again, historically, when things are going bad, consumers trade down to dollar stores. Now they're trading down from dollar stores. That little change in one word to the other is very meaningful. Very meaningful. Look at the way I'm looking at you.
Yeah.
Very meaningful.
Where did they trade down to?
You should read the report that the Dollar Gen CFO gave, I want to say almost a year ago. I mean, they talked about trading down to like soup kitchens and those types of things.
Yeah,
but one of the things
very scary.
We've also talked about this, trade down from a higher end consumer. If they can pull up Walmart here, this stock is trading 1% from an all-time high, and it seems like they are the huge beneficiary of almost every retail trade, right? When you think about it, and something's got to give here, guy. Up 35%. Look at how much it's gained just since its last earnings report.
It's their world right now. But you're right. I mean, if they see, if out of the blue they see sort of an inventory problem and it affects margins, I mean, they will take Walmart out to the woodshed faster than you can say Walmart. But that hasn't happened yet. All right, questions. I'm going to go in order. Tyler, and I'm reading. What's your guys' thoughts on UPS revenue down 30%? I think that should be a heads up for the future of the economy and its direction. Okay, so Elizabeth just talked about UPS. I'll say this. Yes, I agree with that. But a lot of UPS's problems are UPS specific. I mean, I will say this. They've had some fits and starts along the way. And here's a stock, Dan, that made its all-time high, I want to say, like 2 years or so ago. Maybe it was even longer than that. You know what? It was January of 2022. And the stock has not traded particularly well on what's been a very good tape since. So FedEx has actually done really well stock-wise. UPS, not so much. I think UPS is a tell on the economy, but I think a lot of it, by the way, Tower, is UPS specific.
Yeah, and on the single stock or the company-specific sort of stuff, Guy, I remember that was a FedEx issue too, you know what I mean, for a few years. And so
FedEx, again, they finally sort of figured it out.
Listen, the question here is how much of it is company specific versus, economic here. Trades very cheap to the market. But FedEx does too, actually. They trade at very similar multiples. So again, I'd say not there yet, but sooner or later you have to make a bet that they're going to get things turned around.
For Elizabeth from Scott A. I would like to know Liz's thoughts on why money supply is growing. I didn't know that it was, by the way, but if he says it is, I'll take his word for it. I don't know if you have the answer to that. I'm not looking to tee you up.
I mean, I'd have to look at the numbers directly and which part of money supply you're talking about. So Scott, send us, are you talking about M1, M2? What are we talking about here? But part of it is that financial conditions do continue to seem to ease.
Yes.
And money supply is part of that. So we do still have buying happening in the treasury market. I think that slows down as time goes on, but we do obviously have more liquidity in the market than I think the Fed expected, certainly more liquidity than many investors expected. So we've got these easier monetary conditions that persist, which is another reason why it starts to be really questionable when the Fed starts to cut rates. Could it even just fuel inflation again? And that is a big risk.
Bingo. Wavy McFly, who you're familiar with.
Oh, yes, Wavy.
Wavy,
Hello.
Wavy.
Not born with that name.
As
I
we
beat
have
you to
mentioned
your
a
own
number of
joke.
times.
Yeah.
Unless his parents are like comedians, like maybe his father was
Maybe.
Don Rickles. Who knows? Can you guys explain how market maker dealer positioning influences the market? This is a Dan Nathan question, without question. Dan?
So interesting. And so there's two different sort of markets that I focus on. Obviously, equities is important, but there's also the options market. And I think options dealers have much more influence on the pricing of markets than, let's say, equities. Like, when Guy started, they were trading equities in like dollar increments. When I started, they were trading in quarters and eighths, and then they quickly went to decimalization, and that was all electronic. A lot of liquidity there. I just don't think there's a whole heck of a lot of influence. Oh, and also open outcry in the NYSE. You had specialists that could do whatever the heck they wanted with the stock. Now that's all gone, right? So you think about the options market, it is a supply and demand thing, but there's lots of things that go into the pricing of options. And there's a lot of options that trade versus stock. A lot of dealers delta hedge them, or they decide when they want to do it. So, dealers still have a whole heck of a lot to do, I think, as it relates to options, much less so as it relates to equities.
Elizabeth, what do you call a man with no arms and no legs on your wall?
I don't
Dan?
know.
I don't know, guys.
Seriously, you don't know this?
No.
Okay, what do you call a man with no arms and no legs on your front door? Front door step. That would be Matt. Okay?
No, the way the joke goes is, what is the name?
Yeah.
What do you call a man with no
What's the
arms
wall
and
one?
no legs on your wall in your house? On a wall in your house? The answer, of course, to that is Art. We have a question from Art.
God.
You guys need to discuss. And by the way, Art, we talk about this stuff all the time. Art, you get it? Like,
I get it.
You put it on your wall.
Unfortunately. Okay.
Come on. You laughed at that.
Dad joke.
It is funny, though. The total government spend is now greater than, listen, it's outrageous. And that's, by the way, Art, this is one of the many reasons that I thought yields would go. And I still think yields, at least 10-year yields, are going higher because of all the things that you mentioned. And if any of these rating agencies ever pull their heads out of their collective, you know what? It's just a matter of time before they take a good look at what's going on in the U.S. and evaluate our credit and have some sort of credit downgrade, because it's preposterous what's going on. Where, in terms of debt to GDP, in terms of debt, all those things, throw them in a pot. It's a very hard thing to extract oneself from. And I think that's why Art yields are going higher.
Yeah,
Elizabeth,
just really
okay,
quickly,
Dan.
1 second. And listen, we flirted with debt downgrades here in the U.S., and I don't think that these rating agencies have a whole heck of a lot of credibility for all intents and purposes. But the one thing I'll say is, like, it could have a massive domino effect, right?
Yes.
If you cut the U.S.,
Yes.
like, think about how many other crap nations there are. Think about China, like, you know what I mean? We've talked about the trillions in dollars of debt in the shadow banking system. So again, I don't think anybody has an interest in that happening, because we could find ourselves in another global.
No, I
financial
don't have an interest
crisis.
in that happening. I'd be surprised if it did happen, just because of the risk. It's not even that something would happen with the debt itself. It's the risk of just saying out loud that we're downgrading U.S. debt. And look, if the 10-year yield rises, it only has to rise, by my estimation now, it only has to rise 14.9 basis points, and the yield curve is uninverted, which is not a good signal.
I'm with you.
We don't really want that.
This is from Jay, who's here every day. Chart check on GD. I believe he's talking about General Dynamics. Buying. Okay, so General Dynamics, I think, recently made an all-time high. If I'm not mistaken, I'm typically not. It has pulled back to about 285 or so. Throw up a chart. Look at that. It's amazing. I mean, this is. You think I make this stuff up? I'm not.
Well, you do have the benefit of a fact set machine.
I'm not right now. I'm just doing this.
I'm just saying.
So we're about to trade down to the 200-day moving average. I think you do buy it. Look at Lockheed Martin. We didn't mention this, by the way, although I sort of flirted with it last night on the show. Does anybody know what's in my clam? Anybody?
It's Chevron, Lockheed,
Agnico Eagle
Yeah,
Mines,
what's I gonna get
and
that?
Martin Marietta. Now, Liz, you're looking at me like I got.
No, I remember you guys explained this to
Yes,
me once.
okay,
You had to
so-
do a 4-letter acronym for the stuff.
Wow, Guy, Lockheed was your final trade
Look
on
at the-
CNBC a few days ago.
Look at that Lockheed Martin.
Wow.
That's on the back of earnings.
Wow.
So to answer your question, Jay, yeah, I think all the defense stocks are in play. I think General Dynamics, you're probably getting a gift on this pullback down to the 200-day moving average. Okay, that's that. This is from Cause Why Not. That's a great name. This is a new name for me. Is there a point at which Dan and or Guy would consider buying CrowdStrike, or is this something?
Ooh.
So the answer is yes, there is a level. Now, incorrectly, I thought CrowdStrike would hold the prior all-time high. If you go back and look, it made an all-time high, I think, in October of 2021. Longer-term chart, please, and you'll see. There you go. I thought it would sort of hold those levels if you go up, 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 and you can see the prior high. That being said, now one has to wonder if the 200-day moving average is in play. So I don't think you got to find a place to buy this, Dan, not sell it here. But clearly we have violated those prior highs.
Yeah, no doubt. I mean, listen, I would put what happened here over, well, I guess it was on Friday, up there with the Chipotle bad lettuce situation. A lot of the stuff that's happened with Boeing.
Is that a metaphor?
Well, no, but this single
Bad
point
lettuce?
of failure when
Oh.
when you think about and the havoc that it wreaked. I mean, this company is going to take a while to dig out of it from a credibility standpoint. And the other thing I'll just say is that a lot of the companies that relied on this technology, so it wasn't a cyber attack, it was a man-made error on their front. You know, you need to have second sources, and a lot of companies that already have them are going to be looking away. So we're not going to get a good sense of this until we see the company's reported earnings. Probably not going to be in this quarter, but their guidance, you'd have to think that they want to clear it out, kind of be really conservative, and hopefully they can set up to a number of beats going forward and not lose too many customers.
By the way, Elizabeth, just to tie a bow on it, Timmy has told me it's M2 that Scott was talking about.
Uh-huh.
So there you go. So
Okay.
thank you, Scott, for. Okay, this is from Matt Walter. Isn't the unemployment rate a better indicator of when a recession might start? So obviously, I don't know if Matt tuned in late or not, but we actually addressed some of this, and I'm not casting aspersions here. Maybe he did tune in late. I think the unemployment rate is a great indicator of what's happening. I think more importantly, Elizabeth, and this is just me, if you look at the revisions for the last, I think, 15 months or so, I think 13 out of the last 15 months, the revisions lower have been eye-opening. Now, why it doesn't matter, I'm not an economist, okay? What do I say all the time? I'm not smart enough nor humorless enough to be one. But I can read a friggin' statement too.
Yeah.
And at some point, you know, my sense is there's been a lot of smoke and mirrors going on because people know what's happening. The reason why this administration's rate, their approval rate on the economy sucks is because you can throw any number you want at them. They understand what they're dealing with right now. And that's been the problem all along. Anyway, so I do think it's important.
So is it a better indicator? The unemployment rate itself, because we only get it monthly and because it tends to move slowly at first and then it picks up steam, it's the when it picks up steam that you're usually in a recession. So it tends to be more of a concurrent, if not a lagging indicator, actually. But we've seen that little curve. And what we talked about earlier in the show, if you missed it, Matt, was the SOM rule. So look that up. If the unemployment rate goes to 4.2% next month, the SOM rule will trigger, which is typically a recession signal. A better thing to watch is you want to watch the trend in initial jobless claims and continuing claims. I always believe continuing claims are more important than initial. So watch continuing claims. We get that data on a weekly basis. Also watch construction employment, which is a much more leading indicator.
Last one for Elizabeth.
Okay.
Because we're running, short on time.
Okay.
From Gary Webb. This is right up in your wheelhouse.
Great.
Okay.
Thanks, Gary.
You know what? I could sense the sarcasm.
Oh,
Great.
not at all.
Do you think the PCE on Friday will be market moving?
PCE is never as market moving as CPI. And if you actually look at what's changed in the Fed funds futures market since CPI, it's been quite a bit larger than I think what we ever see in PCE. So no, I don't think it's going to be that market moving unless it's way off of expectations. I think it probably just confirms, which has been the case a few months now. it probably just confirms a cooling in inflation.
Yeah, I just want to say one thing about, like, it feels like since COVID, a lot of us have been obsessed on when the recession is coming. You know what I mean? It's been a really hard thing to kind of put your finger on. We've seen, just think about this year, think about inflation. We saw it, kind of rise up the first couple months, and that freaked everybody out, right? And then it's come in really hard the last few months or so. And so I guess as we're like in the midst of earnings season right now, I think the most important thing is just kind of focus on the company's earnings and some of the metrics we've talked about and what the guide is and what the body language is and how interconnected these companies are and the like here. And you'll probably get a better sense for, how soon that recession is going to come, because I don't know about you guys, I'm sick of like looking out for it. And it feels like, if they're tasked or we're tasked with just kind of, giving the market, play by play and this and whatever, it just seems like it's been a fool errand trying to figure that out.
Before we leave, I want to throw up a daily chart, and Elizabeth's back, and this will be interesting, of the TLT. Now, one would think on a day where the market's getting schlemieled, given the decent 2-year auction we saw yesterday, and given the fact that a lot of people think we're going to see one would think that the TLT would actually be trading well today, meaning trading higher today, meaning rates are going lower today. We're seeing quite the opposite.
Yeah. So
just keep an eye, again, one day does not a trend make, but keep an eye on this too before we get out of here.
And I have to say something. I'm sorry to Guy, because I've been misspoken. And as you've been away for the last week, you quoted something, a number of days since the S&P had closed down 2%.
Oh, yeah.
And you were, Guy, you were much closer. She says about 355. I don't know why. I thought I heard her about a month ago say 380, and I was assuming it was about 400, but it's 355. Not that matters.
If it doesn't happen,
but we were just talking about what for us, it just meant the level of complacency in the S&P 500. And so we are really, really close to that. And I wonder, Guy, just really quickly before we get out of here, if we do have a down 2% day in the S&P, if we do have a down 3% in the NASDAQ, it's not likely to reverse itself so quickly. But the last thing I'll just say is, with 2 of the Mag 7 getting hit really hard today, the likelihood of all 7 of them being down this much is not particularly great. We could find ourselves next week when we get to Apple, we get to Amazon, we get to Meta, that they are telling a very different story.
Without question. So I agree with you on all those points. It's worth watching. I think right now the S&P is down 1.76%. So, you can do the math, what it would take us to get there. I guess.
Well, you watch that. You watch that, and you also watch if it stays down 1.7, whatever it's down at, let's say 3:50 p.m. Okay.
Correct.
3:50 p.m. Eastern time. If the drawdown accelerates into the close, that's usually an indicator too that things are worsening, right? There's not sentiment. There's not buy the dippers that are coming in at the end of the day and saying this is an opportunity. It's something where you have more widespread selling.
Buy the dippers.
Buy the dippers.
I used to make at Carvel, you had a cone and then brown bonnet. You'd have to dip it in. Yeah. Now, okay, nobody.
What are Wednesdays? What are Wednesdays at Carvel?
Wednesdays are Sundays at Carvel. I worked at Carvel, but it's very difficult. The proper way to make a cone at Carvel is you don't put the ice cream inside the cone because you use more ice cream. You don't want to do that because that cuts into your margins. You start around the edges of the cone and go up, so it gives the appearance that the entire cone is filled. So it's a bit of, as I said earlier, an optical illusion. But in order to make a brown bonnet, you need that when you turn it over, you need it to hold. So I learned that you would have to actually put more ice cream in the cone if you were making a brown bonnet. For the integrity. Yeah. It's like you're an engineer.
Yeah, you didn't, which I'm not, but I do love ice cream.
You bingo players didn't have that shit on your bingo card. But that's it, Dan. Take us out because I'm tired of talking.
Yeah, really quickly. The Market Matrix, it's read to you by Brunson. It's a podcast we launched, 10 weeks ago, Guy?
I believe
it's
so.
10 of the top stories in the market.
5.
Business.
No, 5.
We're doing 5 to 10,
5
but
to
it's
10.
under 10 minutes there. That's what we're trying to kind of stick to. We curate the stories. Brunson reads them. It's AI generated. Go follow it in your favorite podcast store. Rate it, review it, share it with friends. We appreciate it. That's Market Matrix, MRKT.
Might have been the longest market call we've done since inception. We're coming in on an hour. Thank you for sticking around to the extent that you did. A great EYT joining us. By the way, if you think about this, your initials are EY. I call you Elizabeth. But if I were to call you Liz, it would be LYT, which means you're lit. which you've always been to me.
I like it. Oh, thank you.
Later, people.
All right, thanks.